I'd like to introduce our panel. We have Leon LaBrecque, Jamie Lopiccolo, and Bob Weins. Leon, if you want to take it away.
Sure. Hi, Jim. New Year, everybody, and Happy New Year, Jamie and Bob. Isn't it great to be back on the road show talking about things we get to be experts on for a very short period of time?
Yeah, we thought it was going to be short-lived, right? That we were just going to have to know this for till 2020, and it looks like we're gonna have this going on forever.
Yeah, maybe. Yeah, it'll be PPP3 and PPP4 and PPP5 and so on and so forth. PPP just because us nerds didn't have anything to do over the holiday break, Congress gave us a little extra 5,709 pages to go read. So, in normal fashion, we gave it to Bob and said, "Bob, digest it and give it back to everybody." So I thought that would work out a lot. We're going to go over some things today, quite a few things today. We've got a summary of some things to talk about between PPP2 and some of the credits. The three of us have been banging our heads together, kind of come up with some good ideas. We did a little bit on the tax extenders too. So this is your show and our roundtable for CPAs as we're trying to serve our clients. We'll be answering questions as we go. I'm going to share a screen, and this would be hopefully useful for us. It's we got a good screen share on that, Bob?
Yeah, it looks good.
Good. So I thought we'd just go through some of the pieces of the Consolidated Appropriations Act of 2021. There are lots of things in there. You know, if you're raising racehorses, there was something pretty good in there for racehorse raisers. I'm thinking about getting some more racehorses now. But let's start out with PPP2, and Bob, why don't you just jump in with that and just, you know, who can get it, who can't. You can get PPP1 and get another loan. You can also get a new loan if you didn't get the first loan. So run us by that.
Basically, it's pretty expansive who's included. There's tons of notes, and we can share this later, but there's lots of exclusions. But just let's think about the big picture. Basically, they're saying if you're a business, sole proprietor, self-employed, et cetera, and you were in business, you're in operations on February 15th of 2020, you could potentially apply for the PPP2 loan. If you're not in operations by February 15th, you're out of luck. Now, if you've already applied for a PPP1 loan, so you're a recipient of a PPP1, then you have to have 300 or fewer employees. And they talk about the full amount of your PPP1 loan has been basically spent. We aren't sure exactly what that means, but I'd say a good rule of thumb right now is to say, hey, if you've spent it by before the disbursement of the PPP2 loan, you're probably okay. We'll get some more guidance from Treasury on that. And then you have to have a 25% reduction in the gross receipts in any 2020 quarter compared to the same quarter in 2019. And there's some caveats for that, depending upon if you've been in business in 2019 or not, et cetera, et cetera. And there's an alternative test you can use too. But I say those are the big pictures. The interesting part is this. If you are a first-time borrower, so let's assume that your client did not apply for a PPP1, then they can apply for the PPP1 under the old rules. It's open to them. So 500 or fewer employees. They still have to be in operations by February 15th, 2020, because that was the old rule, and it applies to the new loans too. And they got to qualify under the SBA 7A loan programs, which it's a little bit detailed. We can hit that later if we want to. But basically for most of them, I'd say the big thing is that you can still get a PPP1 loan effectively now if you never got one before, and the tests are a little simpler for you.
Let's run that 25% a little bit, Bob. I had a couple of people already ask me, do we think it's cash basis, accrual basis, calendar quarter, you know, what quarter? I think it's the same accounting method that the entity is already using. This is just my opinion, literally a Leon opinion, which for what that's worth, won't buy you a cup of coffee. But if under the Leon opinion, they're gonna probably declare it to be what you've already used as your accounting method. So if you're already on the cash basis, going to be cash basis. If you're on a fiscal quarter, it's going to be a fiscal quarter. You can obviously cherry pick a little bit, but I wouldn't suggest you could run out there and cherry pick between accounting methods and everything else. I can't see the SBA doing that. And given this extremely short time frame, I think this is going to be a land rush. I think there's going to be a really short time frame. I think if anybody's going to get a takeaway out of today, at least from our end, I think all three of us think you should apply as fast as you can on this and go for your PPP2 quick, because this one could run out fast.
It could. I think we've got some advantages for stretching this out a bit. If you look at PPP1, remember how there were 2 tranches on that? And the first tranche evaporated literally in hours. But if you think about it, that was virtually all large companies, $10 million plus loans. These are at 2 million as a max. You can't go any higher than that. And really, if you look at it, they've excluded publicly traded companies, blah, 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 blah. So there's lots of exclusions. They're trying to get rid of these entities that were just draining PPP1. So I'm hoping that this PPP2 loan program will last a little bit longer. So it's not just a land rush, but you could well be right, Leon. We're going to see.
What do you think of Jamie?
Yeah, Bob makes a good point relative to the people that this is targeted for. But I also know that it's opened up to newer entities and things of that nature. So I think that there's still going to be a sense of urgency. I think, I'm going to take the middle of the road between the two of you guys and cop out on this a bit. But I think that there is a sense of urgency. Do I think it's going to be over, by the weekend? No, I don't think so. I think that we're going to have a little bit of time to do this. But I wouldn't sit there and wait. I would, as giving advice to the preparers on here, start looking at your clients now to see who's going to be eligible, start talking to them. Look at how this is going to, we'll be discussing a little bit later down the road, how this interacts with the employer retention credit and things of that nature. Start doing that analysis now and get ready to do it. The nice thing is that, we're right at the end of a calendar year, so we could be just basically using, 2020 wages or calendar year 2019 wages, so the calculations could be pretty easy to do.
Jamie, we were chit-chatting earlier, and you brought up a great point. I think it's a planning question about the PPP1 forgiveness and its impact on the gross receipts. Could you kind of give us an overview of that? Because it's a great question you brought up.
Yeah, the question really is you have to have a 25% reduction of gross receipts, and then, but the issue is where does the PPP loan come into, and does it affect the gross receipts test? For example, if most people are gonna, most of my clients are seeing the decrease in the second quarter that we've done the analysis on, but they've also received that was without consideration of the PPP. They've received the PPP. Everybody should have received the PPP in quarter 2, and does that add to your gross receipts or not? I think part of that depends on how the loan forgiveness is going to be treated and when that's going to be determined. Because again, if we take the 24-week period, we're looking at saying that, well, the earliest that this would have been forgiven or determined forgiveness would have been made would have been in October, and I'm going to take the loan forgiveness in there. But if I'm cash basis, do I have to include that in there? So that's a question that I think that we need to get a little bit more guidance on. And if we look at I looked at the code section earlier on the definition of gross receipts, and it specifically excludes loan proceeds. So I think that if you receive the PPP in quarter 2, I don't think you include it in gross receipts. But then the question is going to be when is it deemed forgiveness? And that's going to, all of us are going to try to put that forgiveness into the end of quarter 4 if it's to our advantage. So I think that that's one of those things that we have to stay tuned for.
Yeah,
I'll weigh in my professor hat if I could. Putting my professor hat on, a loan is not a gross receipt under normal accounting principles. So the time you got the PPP loan I would say is not a gross receipt. Now, forgiveness could be a gross receipt. I'd probably suggest that's possible. But again, since they made it tax deductible, does it become a gross receipt or not? But Jamie, I think I would say I'd weigh in that when you get the loan, it's still a loan until you get it forgiven. And if it's actually forgiven, it's not. So,
and the only question I have with that, Leon, is the IRS has now come out and said that before this law, the IRS came out and said that you treat it as forgiven in the year that you deem it to be, that you deem that you're going to get it forgiven, or that it's reasonably assumed it's going to be forgiven. Right. So technically, going back to that ruling, you've got an issue now that most of this is going to be forgiven in 2020. as a sense of how we're going to report these as forgiven, because that's when we've deemed them to be forgiven, or that we've reasonably assumed that they're going to be forgiven. The question now is what quarter? You got to now divide that into what quarter is it forgiven. For example, if you received, and we're going to use my firm, we received the PPP early in April. We were one of the first ones to receive it in the first round. Technically, I used that money up by the end of the second quarter, but if I elect a 24-week period, do I go all the way till the end of that 24-week? I haven't even submitted my application in yet, but
Right.
do we wait till the end of the third quarter when my 24-week would have been expired, or do I say that, well, I used all of the loan proceeds by the end of June 30th, and so technically I was reasonably deemed forgiven then? And so if I had a less than 25% decrease in quarter two without the PPP, but if I had the forgiveness in it, you could blow somebody out. So I think that receipt, and then somebody asked the question about the EIDL grant as well. The EIDL grant is would that be considered gross receipts? So I think there's some things that we need to get some clarification on.
Yeah, agree with you there.
And I think I would bet that the EIDL, because the EIDL is a grant and not a loan, so I don't think you could exclude that from, especially now that they're not allowing the EIDL to reduce the PPP forgiveness, or that they're not reducing PPP forgiveness out of the EIDL. I think that the EIDL grant is going to be, if it's going to be considered taxable income, it would be income and is considered gross receipt in the quarter it was received.
Yeah. I'd say the EIDL you're right on, and I'd say under your case that you gave, until the 24-week period was up, unless you tried to apply for forgiveness early, I would say you don't have any gross receipts there. So I would say your 2Q drop would probably effectively work on the 25%.
Right. And I mean, but then you throw into the impact, Leon, is now you've got the $50,000 and the $150,000 limit. So now all of a sudden, do you go into going, well, we already knew the loan was for, now all of a sudden under the $150,000, and it's just a simple application. You still have to track your expenses and so forth. But now do you say that, well, anybody under $50,000 is automatically forgiven anyways? So now do you go in and say, well, it doesn't matter what quarter, the minute you received it, it was forgiven based upon the various laws and rules that have come out?
I'd say it's not forgiven until that law was passed, until that rule is passed. So
I mean, those are going to be the fine.
That's my legal opinion. So, for what it's worth.
Yeah, and those are going to be interesting things to see if that's addressed, right?
Yeah,
but I think those are things that we have to look. And I think that somebody brings up the point that it's a tax exempt income. So if it's tax exempt income, it may be a moot point anyways. But at the end of the day, they may come back and say that this is still, I think we need to wait for clarification on that.
Yeah,
but I think
I agree. It's a question, does gross receipts include tax exempt income? Because otherwise it's just an M1, M2 adjustment for looking at taxable income versus accounting gross receipts. There was a great question that came through, which basically said, hey, do I have to even deal with this 25% reduction test if I didn't apply for the loan originally? I'm now applying for my first time applying for a PPP loan. The answer is no. So it's a big advantage. If you haven't done a PPP1 loan before, you can do that, and this 25% test doesn't apply to you.
Right.
And they added some things in now too. So you get more forgivable costs too.
You do.
Yep.
Yeah.
Also, weren't they, I thought I had read originally that they're also trying to do some more targeted use of the PPP, going back to Leon, your question of whether this is going to run out or not. I think that they're going to allow for first-time borrowers in some of the more economically depressed areas to get a little bit more preference in getting these. So, that may affect how fast other people get them that don't qualify.
I think they did that with lenders too, Jamie and Bob. Didn't they do it with there's more toward credit unions and more toward distressed areas. There's a lot more toward rural areas. So if you're in northern Michigan, you got a better chance.
Yeah.
So I think they're trying to slow down the drain.
Yeah.
So if we jump to the next page, and people were asking, is there a handout? We can share this. I'll defer to to Jim and the rest of the team, keep in mind, these are our working notes and keep being working notes. It means they're a work in progress. So we've literally, the three of us have changed them 4 or 5 times this morning again. We find things and go like, oh, this is unclear. Oops, we can now clarify this, or oops, that's in the wrong section, blah, blah, blah. So, you know, I'm willing to share it if everyone else is, but I just keep in mind, it's a working document. We'd love your feedback. We'd love your corrections and your insights too.
And by the way, use Connect. If you have questions, you want to share this, use the MICPA Connect. That's a great tool. I use it all the time. I know, Jamie, you use it all the time too. It's a great way that we can all communicate with each other and solve these problems together and, you know, do a little bit of collaboration. So let's collaborate as CPAs on this.
And I believe Jim had said that there's a subgroup that they created in the that relative to the PPP or relative to this that we can do a conversation on. Didn't you? You didn't need to join, Jim?
I just posted it again, Jamie. So
okay,
the link is right there in the chat.
Awesome.
You can go to the Connect page right there. If you don't have a profile set up, it's very quick. Just set one up. And Bob, we can then post the presentation there.
Okay.
Edit it and repost it as it changes, and it'll live right there in the files. So it's pretty intuitive. It's a members only social media platform, basically. So, and we do have a special chat room just for this topic.
Okay.
Awesome.
That'd be great. We'll get it to you. And then, and please, everyone take a look at it, shred it, get us the feedback. We're going to learn together on this. And there's going to be a lot of learning going on. Maximum loan amount. If we look at that, it's the general rules the same, 2.5 times your average monthly payroll cost, but it's got an interesting twist. It says the 12 months prior to the time you apply for the loan, which is like the old PPP rule, or you can use calendar year 2019. So you're not using 20, you're using 19, the old rule for the original PPP, which is good because your income, your salary is going to be higher than in 19 than in 20 for the clients. And the cap is at 2 million instead of before it was at 10 million. Now, there's a major thing that's in the footnotes, but it's worth bringing up right now is that if you're under NAICS 72 classifications, which is basically hospitality and restaurants, the multiple is not 2.5, your average monthly payroll cost, it's 3.5. So for your restaurant clients, et cetera, big impact, really big impact. You just went up from 2.5 to 3.5.
By the way, guys, don't you think this affects some of our CPA members? I mean, if you got a CPA firm and you had a decline in gross revenue in the second quarter and you were so busy helping your clients with PPPs, you can now go get a PPP and it's bigger than it would have been under the first one. Plus 150 grand is forgiven.
Show of hands, how many people's billings or collections went to hell in the second quarter as you were trying to figure out the PPP and SBA, right?
I was hanging out with you two. I don't know why I was doing that.
I'm like, I don't know. I didn't do any work in this. According to my billing and my collections, I did no work in the second quarter. So
seems like you were everywhere, though. I don't know how you did that. So.
Yeah. So, you know, but that's, I think that, you know, Leon, you gave some great advice when this first kicked in, and it's, and I think it still holds true is, you know, this is no different than if you're going down on, you know, a plane has an emergency, what they tell you, put your own mask on first before you help anybody else. And I think that as, you know, that still holds true relative to our profession. You know, look at yourself first to make sure that you guys are in good shape, and then start helping your clients.
Agree.
There was a great question just popped. Does the 3.5 times apply to PPP1 loans, I call it? So if you haven't applied, I don't know. It's something we'd have to look at. Great question.
I don't think so. I think that the way I read it is that if you were a service business, you reapply for round 2. That's how I get it. But you just reapply. You would be able to do it. You just have to reapply.
Yeah. Well, yep. So I mean,
but we'll know that when the SBA gives us their regulations, and if it's they'll do it 43 times.
Yeah, because there's a provision in there that allows you to go back and reapply even under the original one, right?
Right.
So you may be able to, you may have to go back and amend or reapply. And if you know, what I've seen is some banks have just said we're not allowing that. So that might be an interesting thing to see if you but a first-time applier may be able to get the 3.5 times. That'll be interesting to see what comes out of the the final rules.
The SBA's got 8 days to give us rules, so that's what they've got to give us the rules by the January 13th. So
yeah, it's titled under the second. The 3.5 is titled under the second draw loans. So I'm not thinking that it's going to allow for it. That's part of the second draw. I don't think it's going to be allowed for the first-time borrowers.
You're right. It is under the you're at section 37 instead of section 36. You're right.
Yeah.
So I don't think it will be. But yep. The other thing to pay attention to, which could have some interesting impacts, is they expanded the definition of forgivable costs. And these expanded definitions do apply to PPP1 and PPP2, which means you could now be shifting more costs. For example, they've got software and cloud computing costs used by the business. They've got property damage and vandalism and looting due to public disturbances. So if you're a restaurant or downtown business and you were caught in a riot zone, those costs could be covered too if they weren't covered by insurance. Supplier expenditures, things you couldn't get before, basically, and those are rather expansive how they define those. So a lot of other things that would be non-payroll costs are now included. And as far as payroll costs, they clarified the fact that you can now not only health insurance, but disability, dental, other things like that, those other health related insurances, those qualify too. So you've got a little bit of expansion on the payroll definition, which means that if you're looking at it, because what we're going to hit later, there's this interesting interplay between the PPP and the retention credits.
Yeah, that's wild.
And keep in mind, I'm going to jump ahead for a second and then we'll come back to this. But if you remember for PPP1, you had to pick one or the other. So either I'm doing retention or I'm doing PPP. For most of us, PPP was much better, so we did PPP. They changed the rule and it's retroactive. So you can now get both retention and PPP. You can't double dip, which means I can't sit out there and say, oh, I've got $100,000 worth of payroll costs and I have a $100,000 PPP loan. I'm going to apply all those payroll costs to the loan and be done. Oh, now I have a retention credit. I'm going to use that same $100,000 of payroll for my retention credit. No, you can't do that. But what you can do is you could allocate some of your costs out of the PPP payroll, put it to the non-payroll, and you freed up dollars that you can now be using for your retention credit. And you can go back and do that. So there's some interesting planning opportunities that we should be looking at.
By the way, friends, Romans, and countrymen, accounting services are now part of forgivable costs too. So
yeah.
Yes.
So Bob, the interesting thing comes is we were advocating, a couple of things that I remember that we've advocated in later seminars was, people kept, I don't know how many of us, but I know all my clients have been begging to start the forgiveness process, right? And I kept telling them, just wait. A few of them have already done that. And if they've used if they incorrectly reported that application or just decided to go all payroll cost originally, they may be kind of screwing themselves, because really what you should be looking at now is saying, let's use that 40% and as much of that 40% as non-payroll, so we could potentially save the remaining payroll to be used for the possible credit.
Exactly.
Yeah. So the thing is those that wait are actually going to see the benefit of that. And then now, but the problem is, even for those that are under the 150, where it's just a one page, you're still going to need to now go through and justify the what cost and how you allocated that. So you're still going to have to go through at least that analysis in case you're ever looked at for that credit. There was a good question here, and I think this is. I'd like to get your guys' opinion. I think I've got mine, but the 25% reduction test on a quarter, do you guys feel that it's a calendar quarter, or do you think it's fiscal quarters?
I think it's how you normally report. So if you normally report on a fiscal, I would say it's fiscal quarter. That's my accounting professor hat saying that. So that's all I'm thinking.
Yeah, when they say first, second, third quarter of 2020, they don't say fiscal year 2020, or they say 2020. So to
Right.
me, that's indicating quarters or calendar quarters and calendar quarters of 2019. They may throw us a bone when they give us the right, but I would be going based on calendar quarters to begin with.
I would too, because they're tying things in for documentation with 941s, et cetera.
Yeah.
So there's
Yeah.
I guess you're right. Well, maybe I'll hold on my answer.
I
If
mean, I
it's
like
fiscal, I'll say I tell you so.
exactly. And then
So it's 2-to-1 calendar versus fiscal, and I'll go with it.
we should have a poll going in the chat. So
Yeah, let's do a pool.
oh goodness.
All right, let me roll down a little bit into what we've
Sure.
been covering here. We did talk about requesting increase in the PPP1. Bob, you brought up that idle advances don't reduce forgiveness amount. I think that's important, an important piece. The covered period is still 8 and 24 weeks. Same basic thing, 60% of the payroll. Loan proceeds are still there. Bob, you were asking whether it's still 1%. I thought it is 1%.
I think it is. I just don't know. It just talks about the interest, non-compounding under 339. I'm assuming they're going to keep the 1%, but that was an SBA decision. So
Right.
it can't be, I think, higher than 4% or something. So I'm just not sure about
Yeah,
that.
I don't know. Jamie, do you know if it's still 1 or is that just SBA administrative?
I think it's still just 1. I don't think that they've. My understanding of this law, it didn't create anything new. It just changed certain things. So my thought would be is unless it was specifically addressed,
Yeah.
the initial PPP is still in play. And so
That's
if they haven't addressed the interest rate or the terms, I think that the 1% 5 years still applies.
Yep. Now there's one thing I want to jump back for the idle advance. If one of your clients had an idle advance and they already got their forgiveness, you can apply for a refund of the reduction or the forgiveness on the unforgiven amount if they haven't paid it yet. So in other words, if I had a $10,000 idle advance and that was offset from my PPP forgiveness, and you've applied your loan, they'll let you amend it and get the 10,000 applied. Or if it's already been offset and you've got a loan, you can apply to get that loan credited out for the 10,000. So
I should have listened to us and just waited to apply till this law came through.
yeah.
Yeah. Obviously, the big news, and everybody knows this already, is that all the expenses with PPP1 or PPP2 are deductible. So, all the outrage and teaching that we did, and thank you, MICPA, for helping, lobby for this. I remember that Bob Doyle sent a note out with Small Business Association of Michigan. We've gone a lot of different places. I know I actually wrote a note to some friends of mine in DC, the ones that weren't getting in trouble for doing something else. And I just think it had an effect. We went back and said, look, your intent's being thwarted by the IRS, and it's now not being thwarted. So the tax treatment, huge. That's a huge thing.
Oh, it is.
Our deductible.
Yeah. And it applies to not just deductibility. If you bought assets with it, those things that you get basis and all, it's just treated as regular old income, but not.
Well, and plus, there's all this wonderful interfacing that the three of us talked about before, NOL interfacing and full expensing interfacing and all that other good stuff.
Yeah.
But as usual with us, we're talking too much and not answering enough questions. So
yeah, there's a few questions that came in through. So I don't know, Leon, if you want to go through them or throw
go
them
ahead,
out
Jamie,
there.
you pop them in. I'm doing the screen share, so it's harder for me.
Yeah, so the one Ann is asking, will we be amending the 941s to claim the retention credit on payroll items not used for PPP forgiveness? I believe that's going to be the mechanism to go through. Is if you're going back to previous quarters, I think it's the only way to do it is to amend the 941 and file whatever that new form number is to go with it. So yeah, I think that's going to be probably the best mechanical way to do that. Then John is asking, is revenue measured by, I don't know what the OW, the company reports. So I think that's, and then he followed up with something relative to, measured on a company revenues on the tax return or on the financial statements accrual book versus tax. I think that this is going to be based upon so the revenue is probably going to be based upon tax ID number or whoever the applicant is across the company, not on various locations or anything. And then I think the other side is I don't know. I think that's going to be up to the banks. I have a feeling it's going to be left, the gross revenue measurement, I have a feeling is going to be left up to the banks to make a determination on, shy of anything else. But I would probably guess it's going to be tax return, or you could probably use either one that's more to your advantage for right now. Because that's a great question. I've got clients that we do financial set of books, and then we convert them to cash for tax preparation. And I think because this is a treasury issue, I would venture to say, guys, that this is going to be whatever you file your tax returns on.
Right. I would guess you're right, because that's something that they can verify.
Right.
And say, you submitted to us. You've attested to this being the accurate number.
Yeah.
Yeah.
Can't say it's going to be different than that. I would say it's whatever you filed your tax return as is what you're going to get. Do you guys want to hit the ERC, or you want to hit the special credit for, we've got two pieces here.
Let's hit the, I think the, we can come back to that if we want. Let's go to the ERC. I think that's probably more important for us.
I was fascinated by this. When I first read it, I went, wow, that's great. Maybe and then all of a sudden it struck me, maybe the ERC is better than the PPP. And, clearly you can use both now. I mean, that's a really interesting thing. So I don't know. It's one of these wild pieces. I think we're going to be I think there's going to be a lot more of the ERC coming out of this. At least that's my point.
Mm-hmm.
Yeah, I think that I agree with you. I think that this, I mean, just in our conversation over the last couple of days regarding this, has made me rethink that okay, now all of a sudden it was nice because you had two paths, right? You could either go PPP or ERC, and typically you win ERC if you didn't qualify for the PPP. And now I think we have to, as practitioners, we have to now revisit and look back at the ERC for our clients and see if there's some potential there. Even from the way that we're allocating wages for forgiveness and so forth. I mean, I even looked back at my own firm and said, well, there's some potential there if I had enough reduction in gross receipts, and does, do all of these wages count or what have you. And so I think that this is now just made tax season a lot more pain in the neck, to be honest with you, and saying it nicely, because now we've got to start looking at this, and really, from this perspective too, that 30%. How do you not advise your clients now to start considering end of the quarter revenue recognition to try and see if they're close to that 30%? There's some things that now we're going to have to be looking, because that 30% is more attainable than the 50% sometimes as a reduction. And so now it's conversations with your clients of what does the first and second quarter of 2021 look like for you guys, to find out if we can do this and go from there.
Yeah, when actually I think you're thinking of 30%, that's it's a 20% reduction.
20%, right? 20%, yeah. 20%, yeah. So that's more, and that is only, and Bob, clarify that for everybody. That's only available for 2021 quarters 1 and 2. Exactly. It's not retroactive back into 2020. That still is at the 50%, correct? That's your understanding?
Yeah, it's my understanding. Same with the 70% on the 10,000 per quarter. That's only for Q1 and 2 of 2021. If you go back retroactively, which you could, if you can do the PPP on this together and kind of what we talked about earlier, massage my numbers so that I'm using non-payroll and I can free up payroll for the earned retained employee retention credit. That's still a 50% test, and that's a basically 50% up to 10,000 for the year.
Yeah. And so I think that answers, Steve had a question about that, saying that if you claim the credit for 2020 and got to 50% up to 10 grand, can you go back and take the other 20,000 allowed? No, that extra 20% is only allowed for 2021.
Exactly.
Yeah.
But I still see this as a big thing.
If you took it if you took the 50% credit, you can take the 70%. Some people are wondering, are you capped if you've already capped out? It's like, no, the 70% is a new start.
Yeah. So everybody hold off their gross receipts until April.
Mm-hmm.
So but there again, you got to decide if this is better than the the credit, because it's going to be a calculation thing, because either one of these represent cash back to the business. It's just a matter of which one's going to be better, cash PPP or whatever, and especially if you have a 20% decrease in the prior year or
Right.
25%.
But then we've got the same simultaneous equation problem that you brought up earlier with the PPP loan. Says that if I've got this and I've got PPP1 forgiveness, how's that impacting my 20% reduction in gross receipts? So
Right.
we don't know is the answer. So
Right, we don't know.
Yep.
And hopefully by 8 days from now, we will know, but we don't.
Exactly. So
Okay.
I think those are the key parts. There is an alternate gross receipts test, because keep in mind the new rule basically says that if you couldn't run operations because you were shut down because of COVID-19, then you can use the employee retention credit. Very few people are going to come under that. So now you got these retention, you got these reduction amounts. But if that rule still's out there for 2021, but then they added an alternate gross receipts test. So basically an employer can elect, and it's an election, to look at the preceding calendar quarter and compare it to that quarter in the same quarter in 2019 and see if that ends up with a reduction.
Bob, is that a typo on your, I'm looking at the Word document where you say employers who are not, that's if they were not in business qualify. So for that weren't in business, they get to compare 20 to 19. But for those that are in business, they have to compare 21 to, are they comparing 2021 for that decrease, that 20% decrease? Are they looking at 2021 compared to 2020 or 2021 compared to 2019?
Well, it gets weird. Let's do this. Let's say, so you've got an employer who fails the gross receipts test in Q1 of 2021. He could still qualify in Q1 by electing to compare the gross receipts of Q4 2020 to Q4 of 2019.
That's how I read it.
And use it for the first quarter of 21.
Right.
That's how I read it too.
And if you qualify under that, then you're just, for the calculation purposes, then you're just using the Q1 wages. You don't get to use Q4 2020 wages. So it's this weird test. It's there. So keep in mind, you've got two. Now the question becomes this. Let's assume that for Q1 2021, I do that. So I'm using my Q4 2020 and I'm comparing to my Q4 2019. And I say, yep, I passed the reduction test. Am I stuck with that election for Q2? Don't know.
Don't know. And do you do ending your 941? That's my question. The answer probably is yes.
Yeah.
Well, you would be doing the wages though, based in the first quarter of 2021 in that scenario.
Yes.
Right.
Right.
So you would just be part of it would be the first quarter 21 941. And then the question, then the unknown is what do you do for your analysis relative to Q2? Do you go back to Q1 versus, or do you use the Q2 reduction? That's that's interesting.
Yeah, don't know the answer to that.
Yep.
Lucky us.
Yeah, there'll be lots of interesting things going on.
Right.
I knew I should have put a bottle of Jameson next to me as we went through this.
Oh, you didn't? Oh.
You didn't see that I was looting Jamie's office. I had looted his office and took all the Jameson.
Oh,
A man can't have whiskey named after himself. So that's
there you go. Oh, goodness.
A question, is there anything guys you want to hit on more on the retention credit?
No, I think
you got to look harder at it. There's a lot more to it now.
Yeah, there is.
Yeah,
I think ignored it before, and it's it was almost like an automatic. You just said, "Oh gosh, we don't need the credit. It's not worth it." It really is worth it.
Yeah, Jim, somebody did a poll. I would love to find just out of curiosity, of those practitioners out here, for PPP2 and the credit. I think most practitioners in round one did not charge for the PPP application and so forth. I'm kind of curious on how many people have revised their thinking relative to PPP2, because now I think you have to coordinate it a little bit better with the retention credits and even the forgiveness. And would love to find out how many people are going to turn this better into, from a practice point of view, turn this into a billable event. I would think that we're going to see a good portion of these, that maybe gave away PPP1 applications are going to now figure out how to charge for PPP2 applications.
Well, I think it's a lot of work, and like you said, spent a whole quarter doing free work. Bob, well, so did I. So did Bob.
No, I think there was a need in a community involvement and such a, the pandemic was such a, the shutdowns affected a lot more than just the restaurants, and some of it just really kind of was just okay, there's a sense of community, we got to get this thing up and running, and we got to help our businesses survive. And now I think that we got through that, and yes, we still have a little bit of a shutdown, and we have to help our restaurant clients. But I think that, looking back, I'm looking at doctors and dentists and some other businesses that have been working all year qualify for PPP2 because they had that decrease, but have made up for it since then. And so I don't feel as bad by charging them for advisory services to do that. And somebody had put in there, Mary Jane, that we were prohibited from charging. We were prohibited from charging for the application, but going through the analysis and stuff like that, we were able to charge them for. If we wanted to, we did have the ability to charge them. We just couldn't charge them to submit and prepare the application. But guiding them and getting the information and gathering was all allowed. Even the AICPA had issued a statement on that said that was allowed. So just kind of curious on that.
Paul had a question about the calculation for forgiveness, the same as PPP1. No, it is slightly different. The eligible payroll costs are bigger because they include accounting costs and some other things. Got to remember that.
Right.
Well,
right.
Yeah.
But I think the 60% is still there. The 60/40 is still a requirement. Right. So even though that you have other costs, you still have to keep that 60/40 relationship.
Yep. Right. But the 40 can be bigger now because you can add accounting fees in there. You can add some other things into there. You can add cloud computing into there.
Yep.
Yeah. And Ann asked a good question. Thoughts on the ERC and full or partial suspended requirement? Does the more recent MIOSHA rule prohibit in-person working meet this rule? And I think that I think it does, in my opinion, but I don't know if what you guys think relative to, not being able to go to work and things of that to qualify for the credit.
Is the question, did the company get shut down because of MIOSHA rules? Is that where we are?
Well, I think that they were, everybody had to work from home or couldn't go into the office or things of that nature. So it substantially changed their.
Sure. Remote working doesn't qualify. So if you can do remote work.
Yeah, but there was another requirement that was a little bit more loose than
yeah, and
right.
let me see if I can find that.
I'm drawing a blank on it, but I think that it may, but yeah.
Yeah, I've got to look that up again. But yeah, we can take a look at that and add that to it because that was one of the old rules. And to be candid, and I'm terribly guilty of this, I had no one that came under that in our client base, so I kind of said, oh, okay. And I don't remember how expansive it had to be, but there is a two-pronged test.
Yep. So. Yeah. So it's. I don't think that the MIOSHA rule, because it could remote workly, you'd have to still have some sort of a decrease in your business operations. But there was something relative to that. So I would just have to. Maybe I'll look for it, and we can circle back with Ann on that. Yeah,
and we can take a peek. Now, there was a question that came up about EIDL loans and the EIDL grants. Can we apply for those? And we can. The EIDL grants are still available through this year, through December 31st of 2021.
Yeah.
So if we want to do that, now there's also, and keep in mind, like I said, the EIDL amounts, the advances are no longer treated as an offset for the forgiveness amount. So that doesn't, that's not going to be a reduction in forgiveness. That applies retroactively. So if you've already applied for PPP1 to get your forgiveness and you had an offset, you can adjust your application and you should not have an offset for the EIDL advance. And then there's this targeted EIDL advances, which is interesting. So and there's three qualifications. So if you got an entity that's in a low income community, and if they experience a 30% decline in revenue over 8 weeks in 2020 as compared to the same 8-week period in 2019, then, and they qualify for 7B2 small business loans under the CARES Act. So it's section 111110B of the CARES Act is the section you want to look at. Basically, they're eligible to get a grant, an EIDL grant, and the EIDL grant's going to be equal to what they received under the CARES Act, so they can get $10,000. And if they had applied, let's say beforehand, and they got a $3,000 grant, but they could have gotten $10,000, then they get to top it off to the full $10,000. So basically they're saying, if you're one of these targeted groups and low income community, 30% decline in revenue, the 7B2 is basically saying if you're a nonprofit, et cetera, church, you might have some questions, but for most of the for-profit small businesses, you're good. And you should be looking at that because you can top off your EIDL grant or EIDL advance to 10K. And so you should be doing that with your clients.
Hey, here's a great question that Becky asked. And I think it just really, the bigger question is when is the measurement date of those 300 employees?
Yeah, that is a good question.
You know, they were under 300, but then they went through a, or I'm sorry, Dan asked the question, 300, but added a location in February of 21, and it's going to take them over the 300 count. Is it at the date of application, or is it as of the, you know, the measurement of the payroll, the payroll taxes, or the payroll that you're using? That's a great question, Dan. I don't know the answer to that. I would think that it's going to be based upon, because you've got to sign typically you sign a certification that all things are accurate and true at the date of application. So my thought is it's going to be whatever the employee count is at the date of application. Shy of anything else on the indicating something different.
Why don't we write that question down, because that's one we can clearly respond to. I think we're going to find that under the old CARES Act. I don't think they made any adjustments to that. And that with the rulings on it were pretty clear.
Yeah,
now, I think so too. And I thought if you had separate locations that you could count the locations separately. But
no, you still have to know for the key. Remember, you had to still, under the small business definition, you had to, that was the part of this definition of a small business was, and they needed you to take the aggregate group to determine the number of employees that you had. So yeah. I think that it would still, you could still get separate applications, I think, but you still had to look at your aggregate to determine if you had over 500 employees or not in the aggregate. So right. I just don't remember what the measurement date of that employee, because this is a great question relative to, you know, when is the measurement date of that? And you know, I think that it's going to be probably at application date, but it may not be. It may be, you know, based upon when the payroll reports are used.
Yeah, and you don't have to aggregate. You're right, Leon, about the not having to treat the affiliates. You can treat each location independently. If you were a NAICS 72, yeah. So yep. Your hospitality and restaurants, you could do it. They also expanded that non-affiliation rule under the new act to news organizations. So certain news organizations, if you've got locations in multiple cities, et cetera, you can segment those two. You do not have to group those together. So there's a couple little twists like that.
Like hospitality businesses, yeah.
Yep.
Yeah, hospitality businesses is the big one. You know, hotels, restaurants, et cetera. So if you've got a client that has, you know, 14 restaurants, then they could treat each one of the restaurant locations independently. They wouldn't have to do that.
Do we want to touch on a couple of other points of CAA and just, I mean, the expanded unemployment benefits are pretty normal. That's nothing much different than the federal pandemic unemployment compensation. Yeah. You did have some things in there for self-employed people who could still. It is.
They kept those rules, so those still apply. Yeah. The $600 a week is now $300 a week. You know, that's what was around, and it disappeared, and it's back at 300. There's questions about who's going to get the 300. If anyone has any good inroads and can make some entrees for us to the Michigan Unemployment Insurance Agency. Let us know, because I know I can't get through. But if you've got a road for us, let Leon, Jamie, myself, Jim, somebody know. And if you could make a nice intro, because we've got a bunch of questions coming up on this, and it'd just be nice to see, even though you understand the law, the question is, how is it going to be implemented? And we'd just like to understand the mechanics of implementation. So, and we could share that with the group the next time.
And there's a couple other miscellaneous provisions that got thrown in CAA, business meal deductions, deferral of social security tax, FSA, student loans. We want to hit on those a little bit as we start closing up, or?
Sure, we can just hit on real quickly. Basically, they're saying if you've got a student loan reimbursement program, those can continue. They're still subject to the annual limit of $5,250, so you're good on those for a while. Healthcare independent FSAs, they're basically letting you roll those over. So beforehand you couldn't, so you can take the 2020 and you've got a grace into 2021. Deferral of employee social security taxes. Remember, this was the presidential memorandum that lets employee, not the employer, but the employee, basically not have their wages subject to the FICA tax, and they would repay it during the first quarter of 2021. They're basically saying, oh, you can postpone that and you can start paying it between April 30th, 2021 through
Worst
December
decision
30th.
Ever.
That's the worst. That's maybe the worst thing I've ever heard.
I told every client, don't even dream of using that rule. My concern was if they leave you, and now how are you going to get the withholding done? You know, so I sit there and go like, and it's so unclear. I said, don't go there. And then 100% business meal deduction, basically food and beverages for a restaurant, expenses paid and incurred between January 1st and end of December. You can go ahead and you can pick up those.
So I can take you and Jamie to lunch?
Exactly. That's why I went down and I promoted this one, because I wanted to get a free lunch. So that was the whole reason behind that.
Bigger bang for your buck, Leon.
Yeah.
And
So Jamie, I know where we're going. Oxford,
Yeah.
man. We're going to homegrown brewery, right?
There you go. Yep.
And it's through 2022, keep in mind, it's not 2021. So you've got a couple years to do this. The work opportunities tax credit, it was set to expire December of last year, but it's now been extended through 2025. If you've got anyone who works with that, I don't have clients that work with it, so I'm not that familiar with it. Like we said before, idle loan deadlines. This isn't just for the grants, but the loans. So you can apply for an idle loan through the end of this year. Paid family leave and medical leave credits. Basically, they're saying with these, and I got to remember because I got to go to the stuff up above. Let me look at what we got here. Gross income, blah, 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 blah.
Hey, Bob,
Yeah.
I got a question on deferral of employee social security tax, because somebody just gave me a private chat that said the deferral should be year 2020, not 2021 for deferral of employee social security tax. I think it moves that period out for repayment of the old ones from 2020 out to December 31st, right? Not 2021 taxes.
Right. It's deferring the repayment.
Right.
So if I had participated in that program in 2020, my employees right now, I would be giving them this wonderful post-holiday pay cut on their paycheck, because they would now have to start repaying their portion of the Social Security. They're basically saying, no, you can take that and they can start paying that in April 30th. It was supposed to end on April 30th. Now it's going to end December 31st. So, you know, you've got the full year to spread it out versus just picking it in the first quarter, basically.
Right. They didn't extend the deferral. They just extended the payment period of the deferral.
Thank you. Yes, exactly.
Thanks, Elliot, for clarifying that. Appreciate it.
Yeah. Paid family medical leave. Basically, the biggest things on those is those have been extended. So, but the dollar amounts have not been increased. So if someone hasn't used all their paid family medical leave or sick leave, you can use those in 2021. But at the same point in time, they are not if they've tapped them out in 2020, there's no additional benefit being added in 2021. And I think that's probably a good summary of where we are. Why don't we just grab questions?
Okay.
I was kind of thinking of this as well. Brad asked a good question about, could you comment on the understanding of how the tax exempt forgiveness income impacts the at-risk basis amounts for partners and stock basis of S Corp shareholders? I've read a favorable treatment for S Corps, but not for partners. What about the timing of the basis increase? Follow some uncertainty to as when the income is recognized. The only thing that I've read on this is that the forgiveness does not reduce the tax attributes, which I think is indirectly then becomes very basis friendly for the S Corp earners. But I didn't, and I would assume it would be the same thing for partners. But that's about all I saw with that. Any thoughts for you guys? I don't know.
I read a bunch of the
Supposed to be tax
commentaries, and
friendly.
that was one of the questions. They said it's just hanging out there. If you're a member of an LLC or a partnership, how's that going to look? That, being
Right.
taxed as a partnership, it was unclear. So
Yeah. I mean, I read that it doesn't reduce the tax attributes relative to the forgiveness. So again, I think that has a positive impact to the S Corps. C corporations, again, I don't think that it impacts any basis other than the fact that it doesn't reduce the tax attributes of any asset. So I don't think it has a negative impact to a C corporation either.
yep, I would agree.
Yeah. Dan asked, when does the SBA need to come out with final regulations? I thought I had read that it was 10 days after the law was enacted, which
It's
would
the
put,
19th, I think.
is it the 19th? Okay. We've got 2 weeks from today.
No, I'm sorry. Apologies. 13th. It's the 13th.
Okay. So we've got a little bit over a week from today then.
Yeah, it's the 13th.
Okay.
All the new things I get to remember. I'm so happy.
Yep.
Hey, Bob, Allison asked the question on the deferred tax on the employer portion, not the employee tax. The deferral was for both for that one period, right? The employees had to pay it back.
The employees have to pay it back. Yeah.
Right. That's what we all thought was the biggest nightmare in the world.
Oh, yeah. Yeah.
If the employees leave or quit, you're still responsible for paying their share.
Yeah. Yeah. Technically, it would be part of the trust fund even.
Yeah, it's a nightmare. It was somebody who thought that up thought it was just a nightmare. I can't believe anybody thought that up.
Well, that's why it went through as a presidential memorandum versus legislation.
That's good.
Yeah, it was supposed to be.
It wasn't a revenue ruling. It was.
He promised for forgiveness if everybody voted for him. So it was a voting technique for him, I guess.
Yeah.
So I guess this is probably one of the better questions of the interaction relative to. Paul asks if a client used 100% of payroll for the 24-week period PP loan forgiveness and it had excess wages, can the excess wages be allocated to the ERC or employer retention credit? And I believe that that's what we were saying is that whatever's not being used and then that forgiveness is eligible for the ERC now. So I think that that's a good summary there, Paul.
Mm-hmm.
Great.
I agree. That's a key planning thing that we should all be looking at.
Yeah.
Well, guys, as usual, we've talked ourselves into our normal circle for 60 minutes. Any good closing comments, Jamie? Your thoughts on a close?
I think that initially this law I thought was going to be very, very quick and easy and just but as it's proven, there's a lot more complications. So as preparers, I think that we have to really take a look at the interaction of the PPP and the ERC and look at our clients and really kind of take a look at spend the time to help our clients guide through this, because I think that there's potential there for planning opportunities and there's potential for really kind of looking like the superstar to our clients, because the PPP got most of the press relative to this and very little, to be honest with you, but the ERC got nothing. And I think this is a little hidden gem that we can come back to our clients with that to try to get them some back money, and it's even retroactive. So I think doing a sweep as you're preparing year end and so forth of looking at if they've had decreases in the quarter basis and start looking at whether they qualify. For me, I'm starting to get bank statements from my clients from 19 and 20, and just doing a quick analysis of cash deposits to see if they qualify in any quarter before and then try to do it that way. So,
Yeah.
Start planning now.
Bob, anything for?
I would say my summary is, if your clients have not applied yet for their PPP forgiveness, put it on hold for a while. Let's get some more guidance from the SBA and Treasury. And keep in mind, there's a simplified application coming out. That's going to be literally a one-pager for your 150K or below. The documentation you still have to maintain to support audit purposes, but hold off for that too. So I would say my rule is going to be, I'm not moving forward. I'm informing clients and saying, this is generally where we're going. Stay tuned. We'll get back to you in a couple of weeks.
Yep.
I'm with you on the stay tuned. We'll get back to you in 8 days, because in 8 days, we're supposed to have some data.
But I think
So,
in the meantime, there's stuff that you can start doing to get it ready for it. So
yeah,
I wouldn't take the 8 days and just take it. Yeah, I mean, nobody's taking it off, but I wouldn't take the 8 days and not just do anything. I would start scrubbing my clients and start trying to identify which clients we can go through and assist.
Yeah,
right.
I mean,
25% decline. That's going to be
you're looking at saying,
easy to figure that out.
Yeah, if I can get an ERC retroactively, I'm going to do it.
Right.
Yeah.
Yep. Yeah. Well, Jim, you want to add anything from MICPA?
A great segue. So we did a quick poll during the program here, and it was unanimous. Everyone who voted in the poll would like a follow-up. So if I can convince you gentlemen into doing a follow-up roundtable in the next few weeks, we will put that together. I would tell everybody to look for information in your inbox, your email. In the meantime, I am posting the link to the Connect channel again one more time in the chat. Please copy and paste that, ask your questions in Connect, look for information there. We will put the notes from this meeting there. There will also be a video replay of this available later today on micpa.org and our COVID resources. So we're going to just try to keep you as informed as possible and keep bringing you news as it unfolds. Steve Dilley is hosting 2 live webinars on January 19th and 21st, tax season updates. I know that he's going to have a lot of subject matter on this then. So I think there's a lot of resources that we have for you. And if you can't find something,